Indian rupee is down by almost 7% year to date with respect to US dollar. In fact, for the first time in history, USD versus INR pair had breached 80 mark, which means with 80 rupee, you can buy just $1 US. Currency depreciation such as this happens when the value of a given currency, say rupee, goes down with respect to a reference currency, mostly US dollar. The word depreciation is used only in the context of a relatively longer duration of time because generally the foreign exchange market is quite volatile. There can be several political and economic factors that may lead to currency depreciation, such as weak economic fundamentals, growing imports, or interest rate variations by central banks. Now, since this war broke out between Russia and Ukraine, investors have been looking to park their funds in safe and stable markets like US. This has reduced incoming investments for India, leading to weakening of rupee. Also, investors expect the US Federal Reserve to hike interest rates aggressively in order to curb inflation there. Now, this might mean better yields for investors in the US, prompting more Indian investors to look for opportunities to invest in US dollar. Also, increase in import cost of fuel and edible oil had added to the woes of falling rupee. Now, how is this currency depreciation going to impact consumers and investors like you and me? India is majorly dependent on imports. For example, crude oil, metals, semiconductors, etc. And the payments are made with US dollar. Now, if rupee weakens, it would mean we have to spend more in order to acquire these items. As a result, cost of raw materials and production might go up, eventually the burden being passed to consumers like us through spike in inflation. This might reduce our living standard and hamper economic growth as well. Rise in import cost also puts pressure on domestic goods. As a result, prices of domestically produced goods might also go up, adding to inflation. If you have plans to travel abroad or are thinking of taking overseas education, rupee depreciation would mean increase in your expenses. It would also mean India's fuel import bill going up, leading to increase in fuel prices. This will eventually lead to rise in transportation costs in general, which will add to our inflation woes. Now, Indian rupee might remain under pressure in the near term due to fears of US interest rate hikes or increase in crude prices or global recession woes. Here's something that you need to do to ensure you are managing your money right. At a time when inflation is there along with ongoing currency depreciation, setting aside more cash than you actually required might mean eroding its value. So once you have made provisions of emergency funds and have taken appropriate insurance policies, it might be a good idea to invest whatever capital is left over. Some companies under certain sectors tend to take higher foreign currency loans and also import raw materials regularly. For example, oil and gas, aviation, construction, etc. These sectors might underperform if rupee becomes weak. So if you are looking to invest in any of these sectors, first talk to your financial advisor to align your goals and your risk profile with your interest. You might also think of investing in global funds such as US funds. So when you invest in global funds and you want to withdraw your funds after rupee has depreciated somewhat, you might get better INR value. However, whether you will make profits will also depend on additional factors such as movement of foreign assets, cost of your investment involved, and also currency conversion costs. Even if you don't want to invest internationally, consider deploying any fund that you may not require in the next few months or years in plain hybrid funds. This will ensure you have a good balance between equities and fixed income. So while inflation hike and currency depreciation might cast a gloomy outlook, investors can still ride through such uncertain times by keeping a cool head and also arming themselves with knowledge, guidance, and discipline. And if you're still not sure what to do, talk to an expert financial advisor.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.